Today, we're diving into a fascinating scalping strategy that is completely rule-based and, honestly, surprisingly simple. The whole thing is built around just a single candle each day. So let's see what makes it tick. If you're a trader, you know this feeling, right? Your charts are just a mess. They're so overloaded with lines and oscillators and indicators that you can't even think straight. It's total analysis paralysis. Well, what if we could just strip all of that away? The strategy we're looking at today does exactly that. It boils everything down to one key candle and a simple three-step checklist. Let's see how it actually works. So here's the plan. We'll start with the basic idea, then we'll define the core of the whole system, the 4-hour range. After that, we'll walk through the simple three-step checklist. Then the fun part. We'll see how it performed on crypto, Forex, and gold before we wrap it all up with the final results. The whole idea here is simplicity. This is designed to be 100% rule-based, which means it takes the guesswork and, more importantly, the emotion out of your trading. You're not going to need RSI, you don't need a MACD. All we care about is price action around one specific range. So, what's the secret sauce here? Well, it all comes down to something called the 4-hour range. This one thing is the entire backbone of the strategy. It's basically our map for the entire trading day.
And this is it, the core idea. We're not looking at just any old candle. We are laser focused on the very first 4-hour candle that prints at the start of the trading day. The high and the low of that one candle, that's our playground.
Okay, now the setup here is critical, and you really can't skip any of these steps. First, you have to set your chart's time zone to New York time. That's super important to make sure you've got the right candle. Then, on that 4-hour chart, find the first candle of the day. And, this is key, you have to wait for it to fully close before you do anything. Once it's closed, you just draw a line at the high and a line at the low and extend them out. That's your battlefield for the day. All right, our range is defined. Now we can get to the fun part, the actual checklist. This is where we turn the theory into a simple, actionable plan you can actually trade. And here it is. It's really as simple as 1, 2, 3. We've already done step 1, which is marking the range. Step 2 is all about spotting a very specific pattern, kind of like a fake breakout. And then step 3 is just pulling the trigger with a clear stop loss and a clear target. Let's really break down that setup in step 2 because this is where the magic happens. After you've got your range, you drop down to a 5-minute chart. Now, you wait for the price to break out, and this is so important, a full 5-minute candle has to close outside the range. Just a wick poking out doesn't count. The real trigger, the signal we're waiting for, is when another candle closes back inside the range. This little breakout and fail dance is the entire setup. So how do you trade it? It's a reversal strategy. So if the price breaks above the range and then fails, coming back in, you actually go short, you sell. Your stop loss goes right at the very tip of that failed breakout. On the flip side, if the price breaks below the range and then pops back inside, you go long or buy, and your stop loss goes at the absolute low of that move. For both trades, the goal is simple, a take profit that's twice your risk, a nice, clean 2-to-1 reward to risk ratio.
Okay, the theory sounds good, but the real question is, does this thing actually work? So let's look at the backtest from the source material, and we're starting with a market we all know can be pretty wild, Bitcoin.
On day 1 of the test, we saw one single long setup trigger and it was a winner, a nice 2R profit. Day 2 was way busier. It gave us 4 different setups, which together banked an incredible 8R profit. So yeah, you can definitely get multiple chances in a single day. Now, the source material points out a really smart little tweak for managing your risk. What happens if you get a massive breakout? I mean, a huge candle that just screams upward. If you put your stop loss way up at the top, your risk could be gigantic. So in those cases, the idea is to find a more logical key level nearby, like a recent resistance, and place your stop there instead. It just keeps your risk sensible.
But hey, let's be real. No trading strategy is perfect, and it's so important to look at the losses. On day 3, we saw 2 long setups in a row, and they both failed. That's 2 1R losses. It's totally normal, and seeing this gives us a much more realistic picture of performance.
So let's tally up the score for Bitcoin, shall we? Over this little period, we had 7 trades. 5 of them were winners, 2 were losers. That gave us a net gain of 8R and a pretty impressive 72% win rate. For a simple system you just follow by the rules, those are some really strong numbers.
Okay, so the strategy seems to handle crypto pretty well, but is it just a one-trick pony? To find out, the source material tested it on two other huge markets: Forex, specifically the euro versus the US dollar, and of course, gold. And check this out. The Forex test on Euro USD came back with even stronger results. Out of 6 trades, 5 were winners, with only one single loss. That generated a total gain of 9R with a whopping 83% win rate. It definitely seems like the logic holds up in the biggest financial market in the world. And what about gold? Well, this test was a bit more active, with 10 trades total. We saw 6 wins and 4 losses, which still led to a really solid net gain of 8R. The win rate was a little lower, at 60%, but still profitable, and it shows the strategy can hold its own on a completely different kind of asset. All right, we've gone through the theory, we've looked at the individual tests. Now it's time to zoom out and put all this data together to see the big picture. This bar chart tells a really powerful story. Just look at how consistent it is. Even though these markets all behave so differently, the strategy kicked out very similar returns: 9R in Forex and 8R on both crypto and gold. That's a pretty compelling visual right there. And here it is, the grand total from every example we looked at. Across 23 trades, 16 of them were winners. That gives us an overall win rate of about 67%. Basically, 2 out of every 3 trades were profitable. And the most important number? A massive total net gain of 25R. To put that in perspective, if you were risking just 1% of your account per trade, that's a 25% gain. So, what are the big things to remember from all this? First, this is a purely mechanical system. You just follow the rules, no questions asked. Second, it's clean. You don't need any messy indicators. The entire strategy is built on that first 4-hour range of the New York session. And finally, these backtests, even though they're brief, suggest that this simple idea might actually have a real edge across a bunch of different markets. And that brings us to the final question, really. In the trading world, where everyone's chasing the next complicated algorithm, maybe the real advantage is found in simplicity and just being disciplined. Could a simple, repeatable rule just like this be the edge that you've been looking for?